Hello and welcome to our quiet space where we explore thoughtful financial habits. Today we will focus on how embracing low-fee index funds can support a comfortable and steady retirement life. You may feel that investing for growth is risky or complex. But when done simply and with care, growth-oriented finance can become a source of calm confidence instead of stress. In this session we will cover 3 key ideas: what index funds are and why fees matter, how to adopt a growth mindset with moderate risk, and how to integrate low-fee investing into your everyday retirement rhythm. First, let's begin by understanding what index funds are and why they are helpful. An index fund is an investment vehicle that tracks a broad market index rather than trying to pick individual stocks. It means you invest in many companies at once, spreading risk across a large number of assets. Because they don't require frequent buying and selling, index funds tend to have lower fees. Lower fees can make a meaningful difference over many years of investing. Imagine 2 flowers. One grown in rich soil with gentle care. The other constantly forced to bloom fast with heavy work. The gently grown flower may not bloom explosively, but it endures and brings peace. Low-fee index funds are like that steady flower, growth without unnecessary strain. Next, let's move to the second key idea: adopting a growth mindset with moderate risk in your retirement investing. Growth doesn't mean taking wild bets, but rather placing your money in a broad set of assets where you can expect moderate appreciation over time. For example, instead of chasing the latest speculative technology stock, you might invest over time in a global index fund that holds hundreds or thousands of companies. This approach makes growth more predictable, more serene, and less subject to emotional ups and downs. You're not trying to become wealthy overnight. You're aiming for comfortable growth that supports your retirement lifestyle. Think of this as planting a maple tree in your garden rather than a rare tropical tree that demands constant attention and risk of collapse in a storm. The maple grows steadily through the seasons and offers shade for many years. Similarly, your investment grows steadily and offers comfort for decades. Now let's explore the third key idea: integrating low-fee investing into your everyday rhythm. You want your investing habits to feel natural, consistent and aligned with your life, not burdensome or fraught with anxiety. For example, each month you might transfer a modest amount into your chosen index fund and then forget about it until your regular review at year-end. You don't need to watch the market every day. You set your habit, you stick to it, and you trust the passage of time. Let's bring the 3 ideas together into a simple plan you can use. Step 1. Choose a broad index fund with very low annual fees and a global or diversified scope. Step 2. Decide on a modest monthly investment amount you are comfortable with and set it up as an automatic transfer. Step 3. Schedule a yearly check-in over tea or coffee to review how your fund is doing relative to your goals and how you feel about the process. By following this plan, you establish a calm, growth-oriented habit rather than a frantic chase. Let's illustrate with a real-life example. Imagine a person who retired and worried they missed the market gains during their working years. They sit down, choose a broad global index fund with an expense ratio near 0.10% per year, and set a monthly contribution of a comfortable amount. They then set a simple reminder each year for a quiet review while walking in the park with a notebook in hand. Over time, they watch their investment gradually rise and feel more confident about their retirement cushion rather than anxious about timing the market. Another example. A retired couple decide together to channel their spare savings into an index fund rather than trying to pick stocks or keeping everything in low-interest savings accounts. They discuss over a cup of tea their purpose: capital growth that won't keep them awake at night, fees that won't eat their progress, and a habit they can maintain long term. These stories show how growth-focused investing can be peaceful, intentional, and aligned with your values rather than frantic or fear-driven. Now let's reflect on why this approach is especially relevant now. In recent months, many traditional savings rates remain low and market volatility remains high. That means relying solely on savings interest or trying to time market swings may leave you feeling uncertain. Instead, growth-oriented investing with low fees gives you a tool to participate in long-term progress while keeping risk moderate and cost low. Industry research shows that more and more retirement plans are shifting from accumulation only toward income and growth hybrid solutions. This trend highlights the need to balance growth, cost, risk, and habit rather than chasing quick gains. Now we will talk about practical steps you can begin right away. First, look up 2 or 3 broad index funds available in your region and compare their annual fees. Lower is better. Second, choose one fund that meets your comfort level and open an investment account if you don't already have one. Third, decide on a monthly contribution amount, something you commit to but won't miss or stress over. Fourth, set up the automatic transfer from your bank account or retirement account to that index fund each month. Fifth, schedule a quiet annual review. Once a year, review your fund performance, fees paid, and how you feel about the habit and your progress. These steps are simple, manageable, and build calm over years rather than weeks. Now let's consider some common pitfalls and how to avoid them. Pitfall 1. Switching funds too often because you see headlines of big winners. This creates cost, stress, and mistake risk. Better to choose a good fund and stay put, letting time do its work. Pitfall 2. Focusing only on growth and ignoring your comfort with risk. If you are disturbed by market dips, you may abandon your habit. Choose growth with moderation, consistent with your temperament. Pitfall 3. Ignoring fees, assuming they don't matter. Over 10, 20, or 30 years, even small differences in fees compound significantly. Make fees a priority when choosing your fund. Now let's highlight the benefits you will gain with these habits. You will experience growth potential in your retirement assets while keeping stress low and behavior simple. You will feel more in control, because your habit will serve you rather than you reacting to every market move. You will keep more of your returns because lower fees mean less of your money is lost to costs. And you will build a retirement life that reflects your values. Steady growth, ease of mind, and long-term comfort rather than constant worry about performance. Now let's recap our key points once more. We began by introducing the concept of low-fee index funds and why they matter for growth with calm. Then we discussed adopting a growth mindset with moderate risk rather than chasing extremes. We introduced how to integrate these investing habits into your everyday rhythm with step-by-step actions. We illustrated with real-life examples of individuals and couples doing this gently and effectively. We described why this approach is particularly relevant now given low interest rates and market uncertainty. We offered practical steps you can begin right away and discussed common pitfalls and how to avoid them. And we reinforced the benefits of growth-oriented investing done simply, calmly, and with intention. As we draw our lesson to a close, here is your action checklist for today. 1. Research 2 or 3 broad, low-fee index funds available in your region and compare fees carefully. 2. Choose one fund and set up a monthly automatic contribution that feels comfortable and repeatable. 3. Mark one day in the calendar for your annual review. Make it simple, quiet, and reflective. 4. Write down a sentence about how you want growth to support your retirement life. Something like growth that brings comfort, not stress. And finally, let me share a proverb. Little by little, a little becomes a lot. When you apply this to your investing habit, you allow moderate growth, low cost, and consistent action to build strong results over time without noise and worry. This simple truth reminds us that gradual growth through a calm habit can lead to meaningful and lasting outcomes. Thank you for spending this quiet moment of planning and intention with me today. May your retirement investing journey be filled with ease, purpose, and steady progress. Until next time, take care of your money, and more importantly, take care of your peace.